Rates surging this week. That is the big market story. The 10-year yield soaring to its highest level in 7 years, sending stocks sinking on Thursday. So could there be more trouble ahead for the markets? Matt Maley is with Miller Tabak. Mark Tepper is with Strategic Wealth Partners to talk about all this. Matt, how does this episode compare to when we've seen these previous pops in the Treasury yield? What do you think it means for markets?
Well, it definitely scares some people. I mean, we saw earlier this year when at the very beginning of the year in January, interest rates really spiked higher, and it broke. Not just that they just spiked higher, but they broke above a key resistance level with 2.6%. That was the highs back from 2013 and 2014. And when that spiked higher, that really disrupted the equity markets when we saw that whole big scary trade in the VIX options. And so we're seeing a similar thing now, where the yield on the 10-year note is breaking strongly above 3.1%, which is a multi-year high, as you mentioned. So the thing is, people have been talking about how, whenever we see these gradual rise in rates, it's really not a problem. But when you do get the big spikes, like we got back in January, it does create disruption in the marketplace, and that's what we're all worried about right now.
Now, back in January, we're looking at that chart. You had that very sharp double-digit percentage pullback in the S&P 500 right around that time. However, the stock market had been really soaring in a vertical way before that. It doesn't seem like the chart right now necessarily is set up in a similar fashion.
No, but it's certainly been rallying at a very steady pace, and you don't need necessarily to spike higher to have the market roll back over and correct a little bit. I'd also mention that we've had. I don't think we're going to have a major crash, but the recent all-time high was really only a slight one, and it's a double top, and that's exactly what we saw in 2007, exactly what we saw in 2000, just before the markets rolled over. So there are some similarities, there's some differences, but we just have to be a little bit worried. I mean, the one thing I worry about most is whenever the Fed starts a tightening cycle, it eventually leads to a disruption in the stock market, and that's what we could be seeing right now.
Mark, what are the implications for you investment-wise? I mean, obviously one thing we have seen is banks, specifically regional banks, actually get a bid finally here with yields going up.
Yeah, I mean, I think this is definitely a shot of adrenaline for the banks, especially regional banks, with the 10-year hitting its highest level in 7 years, really all because of stronger economic data, a less accommodative Fed, and reduced trade tensions. I mean, all of these regional bank stocks have been on life support because the yield curve has just continued to flatten throughout the year. And in order for these banks to boost their net interest margin, they need to see that curve steepen. So we're finally seeing that happen, which is going to be a tailwind for these bank earnings. So the regional banks are really a good buying opportunity right now. I mean, you look at Huntington, they're closing 70 branches and they're up today on a down day for the market. So there's certainly good buying opportunities if you look at the regional banks in particular.